Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Okay, everyone. We are back with a property update episode. It's been a little while coming. The last time we did this, and for those of you who aren't familiar with it, Smart Property Investment for many, many years. One of the reasons why we created the brand initially was to help all investors navigate investing in property, and we said that we would build our own portfolio under the Smart Property Investment banner and share our successes, our failures, our challenges, our journey investing in property. And we typically get together and I bring in different people who are involved in our portfolio to have a chat and critically assess our portfolio and potentially challenge some of our assumptions and help us shape our strategy moving forward. So this is one of those episodes. Last time we did this was late last year. It was actually in October, so it was nearly a quarter ago. Well, it is a quarter ago. Normally we do this on a monthly basis. I think the assumption from our end is, and the last time we spoke about our portfolio is that we're actually just in a bit of a consolidation phase right now. So last couple of months, has there been much to talk about? Yes, there's been lots going on, but I thought I'd keep our powder dry and save it all for one episode to hook back into 2019, so we can start sharing this journey sort of over 2019 and what we're doing. So the ambition is to potentially do this monthly, but it might end up being every sort of 6 weeks or so. We'll play it by ear. We'll share with you what's going on in these sort of major milestones we hit. When we last got together, I was discussing the portfolio strategy, and at that point in time, it's reasonably consistent to where we are today. It's just really we're in a bit of a holding pattern. We're just waiting until this market works itself out. We're obviously ambitious and optimistic about opportunities moving forward, but we're not rushing into anything at the moment. In this sort of period where we're not buying property, we're spending quite a lot of time, considerable energy and efforts just looking at how we can improve the cash flow position of our portfolio. And the portfolio, for those of you who are new to this, it's about 17 properties, 18 doors. One of them is a duplex that spans Sydney, mainly the western suburbs, southwest suburbs, and up sort of north. We've got some properties in the Hornsby area and also on the Central Coast. We have a property in Melbourne. We also have a property in Wollongong or Port Kembla. Then we also have a number of assets in Brisbane as well, from suburbs ranging from Springfield. This is testing my knowledge and my memory of the portfolio. Geez, where are they? Launton. There's some in Loganshire. There's some elsewhere. So I do apologise. I try to remember, and I think the grey matter's not moving that well since after the Christmas period. But go and check it out. It's all online, all the streets, all the addresses, everything. You can see what's going on. But so anyway, it's a very diversified portfolio is the point I'm trying to make. So we went through a period late last year in conjunction with our mortgage broker, Ross Lacane. He's from Aussie Parramatta. He's done all our mortgages since the get-go, of just assessing our interest rates, where they sit, how they're falling, and we identified some potential savings we could undertake by shifting from variable rate loans into interest-only fixed rates. And we sat down and we looked at the portfolio and worked out what we're not going to touch, what we might touch in the future, whether we need some capacity or flexibility. And we've fixed a lot of the rates associated with some of these properties, sort of 3-year fixed. We've got some pretty good rates. For example, properties in Mount Druitt, a couple of units there, we shifted from interest-only variable to fixed, and went from like 4.79 to 4.25. Another one was 5.29 down to 4.29. 4.79 to 4.29. So some pretty savings there. Property out in Cambridge Park, which you can see on smartpropertyinvestment.com. We shifted that down from a 4.02% to 4.34%. Large property we have up in Mount Ku-ring-gai, we shifted down to 4.19% from 5.35%. There we go. That's what a suburb I was thinking about. Kingston in Queensland, we had property there was 5.8 into 6, down to 4.34 fixed. Another property in Launton from 5.86 to 4.34. Some other properties up that way from 5.31 to 4.19. So lots of savings for us. And we identified prior to doing that process that we should sort of seek between sort of 15 and 20 grand savings a year. And we've brought that back down to about, I think it's about 18 grand more in our pocket as a result of going through that exercise. So I would say the exercise sucks. It's a pain in the ass. so much information required. So I actually had to give a fair bit of effort and attention to it. And I was thankfully supported by other people in this business who helped me out with this stuff. And in particular, our mortgage broker who did all the heavy lifting on it. But anyway, I'm pretty happy with it. $18,000, $15,000, $20,000, whatever it is. It's a lot of money. So I much prefer that to be helping to give greater positivity to our cash flow position. I want to touch on our cash flow position, and we talk a lot about this when we look at our portfolio. And I've said before, I think our portfolio, by memory, each property costs us about $2,500 a year to hold pre-tax. And if you've got one property, that's okay. You can absorb that pretty easily. When you extrapolate it out over sort of 17 and 18 properties, the number starts getting pretty big. And that's our portfolio. And we sort of talk a lot about that. So go and tune into previous podcasts around this, and you get a bit of an inside read. I'm going to do another one of these portfolio updates probably over the next month or so, where we'll specifically just talk about our cash flow position and what our objectives and challenges are in that regards. Today's podcast, what I really wanted to have a look at, and this is something impacting all property investors right across Australia, is how their property portfolio is performing in line with a market which is in a state of flux right now. Property markets are cyclical. This is the way they operate. They always have done. It's not a new thing. Property markets in Australia have gone through different cycles ever since the first fleet landed there at Sydney Cove many years ago. So it's not a new thing. Properties move in cycles. The cycle we're in right now is a very typical cycle. So do not panic, do not fear, do not get swept away with some of the hysteria that you may hear, whether it's around dinner parties or barbecues or through the media. This is a normal cycle, but you need to know how to operate and what strategies to have within this cycle. So in the context of our portfolio, what I thought I'd do is bring our accountant in. I get together with him quite regularly, just do a bit of an assessment of what we're doing and how we're doing, and setting our sort of vision and strategy for the coming year. You've probably heard him on the podcast before, Mansoor Khan. He's a partner at Keshab Accounting. He's been a trusted partner of ours for many years, helping us navigate this crazy world of property. Munzurul, how you going? Welcome back. Long preamble introduction there, but I think we're set to have a good chat now. How's things?
Absolutely brilliant. Thank you very much. Thank you for having me.
How do you feel about this market we're in right now? So for those of you who haven't heard Munzurul talk before, he's a very accomplished accountant, has his own firm. He used to be ex Big Four accounting firms. Technically very capable when it comes to just the practice of accounting inside and outside of property. But Munzurul helps us out. He's one of the very few accountants I know with that has property flowing through his blood, rather than trying to get people to invest in schemes where you might buy some trees somewhere or farm some fish off in the middle of Queensland or something. So Munzurul is a property man. He knows property. He's my turn-to guy, or one of a number of turn-to guys I go to say, tell me what's going on. Make sense of this for me. So I appreciate his opinion. Munzurul, what market are we in right now, and does it concern you or worry you?
Mate, thank you very much. Thank you. You're being very generous for me. And look, the market that we are at the moment is a market of doom and gloom, unfortunately. It's a market where there is a lot of headlines. I mean, I went away in holidays, as we all probably do in the Christmas and New Year. And I came back in the last 2.5 weeks, 3 weeks. And no kidding, I've probably seen some bad news literally every single day, whether it's on the Sydney Morning Herald, whether it's the Financial Review and so forth, that yes, we had about 9% decrease in sort of Sydney in the last year. Yes, we are right at the bottom of the cycle, and we've got all the negative gearing, whether that's going to be taken away, whether all the CGT discount going to be taken away. Lots of negativity in the market, right? So when you are into that sort of a negative sort of a market, it's at some time it's sort of that we lose the track that property investment is still for longer period of time. And as it is with any investment, you go up and you go down. And as it is with any investment, longer period of time is what you sort of look through. So this is a market where there is a lot of uncertainty, election coming in, and all the sort of other matters as well. Now, while we sort of stay into that sort of an uncertain market, then we sort of look back into our sort of individual circumstances, and we sort of say that, well, how are we doing as an individual circumstances? So I, as an accountant, I, as an advisor, sort of from our point of view, what do we advise? So we look into the realistic numbers, right? So you and I, we sort of sat down, we did a bit of calculation, and we sort of looked through how your portfolio sort of performed. And if we sort of look through your portfolio, yes, there is a little bit of there's a little bit of decrease in the last year, right? There's a little bit of decrease in the last year, but we look back into day one where we started and where we are at the moment, we were still done very well.
We have done very well. And what I might do, because there's a couple of moving parts for this podcast, Munzurul, I want to pick your brain about what's going on right now and strategies for property investors and how to make sense of, to your point around doom and gloom and where those opportunities lie. But I don't think it's for today. So what I might do, I might get you in a couple of weeks' time and we'll have a chat about that, because I think that's really valuable. So what I want to do to shape this next sort of 20 minutes of conversation is to apply your knowledge and our discussions in the context of our portfolio and sort of breaking down how fluctuations in capital value change the way that your portfolio performs from a negative and positive perspective, and what you can do about it. So we've just sat down and had some fun, and we actually got my buyer's agent on the phone, Steve Waters from Right Property Group, to join in with us, and we did a really good assessment, and it's sort of a bit of a as tight as you can do without getting bank valuations, just a bit of a look at our perceived or presumed capital values and stress test that against the current market. We've gone and done that process, and I highly recommend anyone with a property portfolio go and do this. And you can get some automated valuations and spend a few bucks on it. That's pretty good. But if you and what I typically do, if you take the approach of being very conservative, you can glean a lot of information out of just the real estate platforms like realestate.com.au, and you can pretty much determine plus or minus a few bucks what sort of valuation you're going to get. So we've gone and done that exercise, and my buyer's agent, I lean on him. He knows these markets, he knows these properties, and yourself. And we've gone and done that. And remember, we have a diversified portfolio with probably a good balance between properties in Sydney and Brisbane in terms of numbers. Sydney property values are higher because we bought there early and we've received all those growth as a result of it. But in terms of numbers, about the same. So what did we work out, Munzurul? It's not sort of blood on the streets when it comes to our portfolio, but our capital value base has contracted a little bit.
It has. So if we go through your portfolios, that as you said, that you've got about 18 or so properties as such. So you've got 9 properties in New South Wales, 8 in Queensland, and 1 in Victoria, right? So as a sort of a numbers, it's sort of more or less in between New South Wales and Queensland. If we look through the dollar value, the market value is your New South Wales market value still seems to be more about 65%. Your Queensland properties is about 30, maybe touch bit over 30, and the Victoria goes a little bit as well. Now, it is diversified between New South Wales and Queensland with a little bit on the Victoria side of it. If we look through the overall asset value, is that based on the valuation that we discussed with Steve from Right Property Group, the valuation seems to be about 7.28 million market value when we add away all of those properties as such. Your mortgage at the moment is about 5.03 mil. So when we take that away as a pre-tax, your net equity is about 2.24 mil. Now, I look back into, say, 9 months ago, that when we did the similar sort of valuation with the Steve, and we sort of said where we are with those valuation at that point of time, there is a bit of contraction, right? And the contraction at that stage is that the numbers at that stage was about 7.4, which was the gross value. So when we take away the 7.4 with 7.28, we sort of see that, well, we dropped about 125,000, right? And we sort of look through, we say, well, what's that as a percentage? 125 against 7.4 is hardly about 1.7% as such over a period of 9 months. So not for 12 months as such, so compounding that it's a bit high. Now, that's probably is one of the comments that I want to say, right? So we look into all the sort of a headline that the market has dropped 8-9% in New South Wales. The other market hasn't done very well as well. But in your portfolio, yes, we have taken a bit of a hit, but not as high.
Okay. And would you say that's reflective of a diversified portfolio? Or if I was listening to this, I'd say, look, that's a load of bullshit. Everyone knows that markets have fallen by 10%. Sorry to swear, because I know you're going to swear a month, but people go, but Sydney's fallen by 10%, so therefore your portfolio, Phil, should have fallen by 10%. I think you're making numbers up.
That's right. And that's where we say that there is a market within market. Yeah. And that's where we say that how did we purchase that? Did we just purchase a sort of a standard mom and dad sort of property, or did we buy it in a very strategic manner? Did we buy the property from a cash flow perspective? Did we buy the property more from a growth perspective as such? So the numbers is that when we sort of say that, well, it's only about 1.7% over the last 9 months or so in your portfolio, we break it down. And we sort of say that, well, within that 1.7%, naturally New South Wales seems to be a little bit heavier, higher than 1.7. It's the Queensland market, which is a little bit more stabilised as such. But even at New South Wales, some of the properties that Steve looked through, and many of them dropped a bit, but most of them he sort of also left it as such, and one or two he sort of increased. So it comes back to the point that yes, it is a strategic buy, it is a longer term buy.
And there'd be an argument, I would say, that perhaps we should have maybe did a portfolio assessment back in June or July of last year, and those numbers might have gone up right before we started seeing these numbers come through. So, it's all about a moment in time. This is an imperfect science. You're never going to get it right. What it is today is going to be different tomorrow. And my recommendation is if you sit there and try and look at how much money you've made each day on your property investment or how much it's fallen, you're not going to get anywhere with it. It is a long-term game. You need to be buying with a long-term strategic focus. So don't think about your property valuation every single day. It needs to be something that's the back of your mind, but it's not like a stock ticker or ASX 200, right?
No, absolutely. I mean, absolutely wholeheartedly. And the reason why it's absolutely wholeheartedly is that property investment is a long-term investment. So always sort of speak about 125 grand drop in the last 9 months or so. We look back in terms of when you started and how much have we started and what have we done from day one as an example. So if we look through that statistics is that we sort of say that, well, we sort of give or take started about 250 odd grand as sort of initial capital.
A cash contribution.
As a cash contribution to initial capital, right? So we use that, we bought a whole bunch of properties. Along the way, you have taken away that cash. So there is sort of no cash being left, so to speak.
Can you explain that for our listeners?
Yeah, so what you've done is that you started with 250 odd grand as a cash and you used that as a 80%, 90% deposit and as 10 to 20% deposit and 5% incidental cost. And you borrowed anywhere between 80 to 90% in terms of purchase of the properties. Over a period of time, some of those properties naturally increased in value. And over a period of time, some of the properties you did valuation. So I spent a bit on the valuation, about 150 odd grand over the years that you've done in terms of different level of renovation as such. So the valuation has increased. So what he did is that he went back into the market and he sort of revalued some of those sort of properties and you increase the equity and increase the loan to 80% and 90% depending on the portfolio. And some of those we extracted to purchase subsequent properties as such. And some of those we sort of say that, well, there is enough equity, so now is the time for us to sort of potentially take back that bit of the cash of the initial 250. So we started with a genuine cash. Over time, through the equity, we've taken out that cash. But if I go back with the statistics and if I sort of say that, well, let's just assume that in a very conservative manner that 250 is what we started with, we sort of haven't taken anything. Because if I say that you started with a zero balance, I can't do any numbers, right? So we start with 250 and we sort of say that, well, what have we done? And within that period of time, your 7.28 minus your 5.037 as your mortgage, your net asset is about 2.24 pre-tax, pre-selling cost. So if we say 2.24 and if I divide that by about 8 years, give or take, that you're sort of investing, 8 years is still sort of about 280,000 per year. So you had an average growth of 280,000 per year. And that is, I think, what we should focus, and not so much in terms of the 125. You had 125 negative, and in future you probably will have another 125 negative as well in sort of the next cycle in, say, 5, 7, 8 years. But the comment is that what is the average level of growth? And that is our 280,000.
So you're saying that every year, because we invest in property, we've added $280,000 compounding on the value
Absolutely.
of our property. Okay. And we put in so to manufacture that much money each year, we had to put in initially $250,000. And to your point, we've taken that $250 back out. So we've just made those gains just by buying well.
Absolutely. And even if I assume that 250,000, let's just assume that 250,000 has stayed within that portfolio over that period of sort of 8 years or so, and I sort of look through in terms of your compounding return is still very, very, very strong over a period of time. Your average return is, give or take, is about 100% per year, assuming 250 was the initial capital.
Okay. So that's pretty good.
It's all right.
So a lot of people sit there and just go, that all sounds really good, Phil. I don't believe it. It's very risky what you've done. Not many people get to achieve that. You've fluked it in terms of timing the market. Everyone who invested in Sydney back in 2011, 12, 13 made heaps of money in property, so it can't be repeated. What do you say to that?
Market goes in cycle. You would always have your ups and downs. You would always have one cycle which is right at the beginning, one cycle right at the sort of the end of that sort of a cycle as such. And yes, sometimes we can become a little bit sort of fortunate, What one sort of argues is that when you're sort of investing about 8 to 9 years, and when you sort of had about 18 or so properties, is that if it were genuine sort of a fluke, we would sort of fill it. So there were a lot of strategic buys, right? So I sort of look back and I sort of say that, well, in day one, you were buying in New South Wales, and you were fundamentally buying in New South Wales for the first 2 or 3 years because the return was good and the value proposition sort of made sense. So your Campbelltown sort of an area and St. Mary's sort of an area sort of value sort of made sense. And you bought for a period of time. And then after a period of time, just the value proposition doesn't seem to be there, right? So the rental return sort of dropped quite a bit, and it was getting very close to your CPI. It was getting anywhere between, say, 3 to 4%. So Steve and you guys sort of moved into Brisbane at that stage, right? With the same sort of the philosophy saying, well, we look through some of the sort of the properties that we buy. So your North Road, as an example, I still remember that in Brisbane when you sort of purchased that, it was a 3-bedroom. I remember it was about 149,000, give or take.
It wasn't a lot.
No, and I remember that discussion that I was having with Steve, and the comment is that, Munzurul, what's the replacement value of this? What's the reconstruction value of this, right? So there was a lot of science was behind, right? So it's about where we bought initially, over a period of time, the diversification as well. We look through the cash flow over a period of time as well, and also we look through into the market. They're a market within market. So even in Sydney, when you sort of bought it, what you did to reduce your level of the risk, rather than buying one big property of, say, 2 million, you bought number of properties into different area. So that by itself reduces the risk.
So the strategy that worked for us 5, 6, 7 years ago in the Sydney market would not work for us today in the Sydney market. It's polar opposite. And this is the point to make to our listeners. Our experience and in building our portfolio is a product of us timing the market when we timed the market, and us buying in a particular market when it was the most appropriate time to buy in that particular market with the right strategy. And that strategy, identifying under market value properties with some sort of upside potential to either manufacture some equity or have a long-term plan in which we can capitalise on it moving forward. When that environment didn't exist in Sydney, we kept the same strategy, but we just migrated to a different market that had those same signs and principles that allow us to continue to achieve that. So we invest in properties with good capital growth potential. We let time do its magical thing, and that is show growth, seeing that we've bought well, and then we've just stopped and moved to other markets. And that's been critical to us. So when I look at our portfolio right now, and when I think about sort of, the capital value of it coming off on paper, $125,000, that's not actually money out of my back pocket. I would only realise that potential negative position should I sell. Now, let's go back to what we originally bought these properties for, and to your point about property being a long-term game. When we sat down through that exercise just recently, Munz, there was a metric that we have on this spreadsheet that says growth since purchase, and some of them are at least 150, 160% growth. Some of them are doubled in value, and this is a product of timing the market well with the right acquisition of the right assets. So yes, I'm very, very happy with how our portfolio performed in Sydney. Have we been able to emulate that in the Brisbane market with the same size of capital growth? No, it's a very different market and different proposition, and we're not looking to invest at the moment anymore into the Brisbane market. We have some great assets up there, and over time they'll be great performance. So when you think about our strategy moving forward, Munzurul, with this particular portfolio, which you can all go and check it out on smartpropertyinvestment.com.au. There's pictures, there's graphs, there's charts, there's stories, there's everything there, right? What's our plan moving forward for the next sort of 12 months with this portfolio?
Look, a couple of things, and cash flow is always sort of in consideration, right?
It is.
So cash flow.
But we'll drill down on that in another podcast. But it is a consideration.
Definitely. So cash flow is one, and number two is the risk mitigation as well. And we always have, and that is a comment that is quite fundamental. That while it sort of appeared that you bought all those 18, 19 properties at sort of a relatively short period of time, but we've done it in a mitigated manner. And so what that means is that if I look through into your loan as of today, even with a decline to some extent with the value proposition, your LVR on the basis of the valuation seems to be still about 69%, right? So there is quite a bit of sort of gap in between sort of what we could have done as opposed to what we have done. So we haven't gone back all the way to 80%. We haven't gone back to 85%, 90% as such. So the risk mitigation was always into consideration, number one. Number two is that we've never sort of invested for tax purpose, so to speak. We said, oh, look, if there is a bit of tax benefit, we take a bit of tax benefit. But it's none of those sort of tax properties that we bought. We haven't bought, as an example, anything which is off the plan and sort of a bit of a dream as such. It's your mum and dad, sort of a typical sort of the Phil, sort of the day-to-day sort of mum and dad sort of properties we bought. So what's our plan, I suppose, moving forward? There are different strategies, right? And there are different level of views. So there's a one side of the view which sort of says that, well, this is the year of a lot of uncertainties. We don't know what will happen. We don't know on this sort of the macroeconomics and the politics what will happen. We don't even know what will happen with the Royal Commission and some of the findings with the Royal Commission. We don't know whether the funding we sort of are absolutely at the bottom of that sort of a contraction of that sort of serviceability calculation from the funding side of it, right? Or whether we sort of moving sort of upward. We don't know. There's a whole lot of uncertainty. So while there is an uncertainty, there is an argument to sort of say that we go steady. And we go steady because, again, property investment is not for a short period of time. It's for a longer period of time. And for a year or two, we look into consolidation, and that's okay from a consolidation point of view for a year or two. We don't need to buy every year, yeah? The other comment which I sort of say is that while we are in sort of a consolidation stage, yes, we still look through the cash flow side of it, but at the same time, we also look through some opportunistic buy. So we never sort of say that no for a no in terms of no action as such, but we say that there has to be a very genuine scientific reason, and only then we take some action. Otherwise, we just stay on the side of it.
So cash flow and I think a lot of people are thinking this right now is, how can I ensure that I can hold out, ride out this particular this particular level of market uncertainty? You only potentially make a loss in property if you are forced to sell your property.
100%.
So the idea is to try and hold on to your property, and you can hold on your property through effective mitigation of any cash flow pressures, right? So that's a big focus of what we're doing, and we've done that work, as I mentioned beforehand, to lock in some fixed rates and stuff, and we'll touch on that again in another podcast. We'll do it in a month or so's time. But putting that aside, the cash flow component of it and our capacity and our ability to hold our portfolio, which we can do. It's not an issue, it just costs us a few bucks, right?
That's right.
On the other side of things is that we just, it's okay not to do anything. You know, we're not going to do anything. Like we're keeping our powder dry, and if we wait until this market sort of really unveils what it's going to look like within the next sort of 6 to 9 months, 12 months, if we're there, we're ready, and we have the capacity to borrow. We have our finance in order, so we can secure finance or at least get a pre-approval. We get to be in that privileged position, or that position of power and strength, to be responsive to the market and to capitalise on that market. I imagine that's where your headspace is with your own portfolio, and that's where I really feel our smart property investment portfolio is as well. We will be reactive to the market should opportunities arise, and you know, for us moving forward, because we have such a good, strong, stable footprint in the Sydney market with this portfolio, when we do get back in the Sydney market, we're going to be looking at some pretty interesting stuff, I feel.
I agree. I am a big fan of looking back into the history. And I sort of say that in a very poetic way, history has a way of repeating itself over and over and over. The numbers change. Maybe some of the platforms sort of change. Maybe some of the external sort of the influence sort of change. But the fundamental sort of remains still the same. So I go back to all the way to sort of say Jan Sommer's book as an example. And I still remember that when I read Jan Sommer's book for the first time, it was written in mid-80s. And when I read it that in 93s or so, and I was like, wow, these statistics are old. But those were written in mid-80s, and if I look back into now, in about, say, 2019, I can still apply those principles. So things which we learn from the history is that the cycle sort of goes with, say, 2 to 3 years of very, very, very tough period of time, 2 to 3 years of declining market. Cycle sort of goes a period of a stagnated market, right? Whether it is, say, 4, 5, 6 years or so stagnated market. Then the cycle sort of tends to sort of go about 2 to 3 years of absolutely silly growth. And when you sort of average all of those out, is that historically we seem to have a reasonable level of return, whether it's a 7%, 10%, whether it's slightly lower as such. It does. We just happen to be in that sort of a declining market. And also the comment is that declining market perhaps arguably has just started. So do we really see a lot of growth in the next year or so? Probably not. But in the longer period of time, you'll do well. So
for us on the smart property investment portfolio, we're looking potentially for some long-term land banking as part of our strategies, correct, Munzurul?
Absolutely. And long-term land banking, I suppose the strategy sort of comes in is that it's the growth. The growth is on the land. And because the finance is very, very, very difficult at the moment, you just don't have that much competition, so to speak. And then we look into a couple of strategic sort of an area, whether the new airport sort of coming through, whether it's a long-term sort of infrastructure as such. And equally important is that cash flow sort of allows us to hold on to those land banking.
Good. Okay. Well, I've enjoyed the conversation, Munzurul. It's much similar to the last time we got together and had a discussion around this portfolio update. Is that for us, this is business as usual at the moment. We're in this period of consolidation, tightening our capacity to hold the portfolio with as minimal outlay as possible of capital. So smarter cash flow management. And there's a couple of little things that we can do as part of that. And when we have that conversation, Munzurul, we'll touch on maybe some granny flats or other things we can do.
Beautiful.
But not a conversation for today. I'm satisfied where our portfolio sits right now, and to come back $125,000 after growth of many, many millions of dollars, I'm not crying. And I think people need to remember that. If you bought at the peak of the market and you probably come back that, you'd probably be a little bit concerned. Right. But our story, the narrative behind our portfolio is that we bought in Sydney at the right time, and to grow by 150%, 180, 200%, to come back 5-10%, I can sleep at night with those sort of numbers.
We've done okay.
We've done all right. So thanks for sharing those numbers, Munzurul. We'll get it all up online, so we'll do another story. Go and check it out, smartpropertyinvestment.com.au. Munzurul, we'll get you back in a couple of weeks' time just to pick your brain on strategies for investors in this current buyer's market is what it is. And please do tune in and look forward to that. If you want to make sure that you know when that podcast comes out, because whenever we get Munzurul on this thing, it's extremely popular for some reason. smartpropertyinvestment.com.au/subscribe. Chuck your email in there and you make sure that you're the first to know what's going on when we release these episodes. Any parting remarks, Munzurul, or we can wait until we get you back on and we can pick your brain a bit?
Not to panic. You only make a loss when you sell it. Hold on to the longer period of time. Make sure your mitigation factors are there. Make sure your cash flows are there. And while we listen to all the sort of the noises, but at the same time is that it's the real information in the long term that we rely on.
That's very sensible counsel, and just write that down. And if you ever start there fretting and worrying about the market, or you've spoken to someone at the barbecue, just listen to what Munzurul just said, and it should hopefully be some common sense for you. We'll be back again next time. Remember, smartpropertyinvestment.com.au. If you like these podcasts, press the subscribe button wherever you're listening to it so that it comes straight into your feed when you know what's going on. Any questions at all around our portfolio or what Munzurul's sort of comments he's made around it, email the team, editor@smartpropertyinvestment.com.au. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.